in Luxembourg, hardly in US, hardly in London. And of course, that was the way to attract foreign capital. From that to today, it is a matter of great pride and satisfaction that India, as a nation of savers once upon a time, is fast becoming a nation of investors. And this transformation is truly amazing. And each of us in our individual capacity are both savers and investors. And we take our calls based on our risk returns between being a saver, that is a depositor, versus taking an investment position, whether it's equity or debt. And this transformation of India, which is now spreading far and wide, where mutual fund systematic investment plans keep on growing month after month, and the Indian asset management industry now reaching global size, particularly in the last few years, is an amazing development as we go forward. Therefore, if India has to finance and truly be competitive, I think one of the main engines for it will be a continued sustenance of capital markets. However, within this, and I agree with Ananta, we have to be very clear that in our desire to build a capital markets led model, we do not forego the concept of stability. And as we have seen the growth in our markets, we have to keep a very fundamental point in mind. Stock markets' end purpose is capital formation. Therefore, speculation, transactions, growth of volumes are important means to a fundamental end, that it must be the engine for companies wanting to raise capital to grow the country. And at times, the whole concept of transactions and trading runs the risk of going ahead of the fundamental purpose of capital formation. And as India goes forward, India must nurture investors, nurture capital markets, and make sure that we provide significant ability for capital formation, efficient intermediation, while handling the risk of exuberance, which inevitably happens with the growth of capital markets. Therefore, really protect long-term, something we are really lucky to have built by design and desire over the last 25 to 30 years, a wonderful capital market base. India is in such a unique position that after the US, we have the opportunity to use the capital market intermediation to build the financing of India's future. And let me pause here by giving another point. Very often when we talk about capital markets, people think only about equity. Debt is a major part of capital markets. And in India, relative to the growth in equity, the liquidity in the equity markets, the buoyancy, the trading volumes in the markets, debt markets are running behind. Now, I will shift for a moment to the other part of the financial intermediation model, which is the traditional saver-borrower model, which is the traditional banking or traditional balance sheet financing model. India will have to make sure that we work with both the models together. But even in the saver-borrower model, just as in the debt markets, we must focus on how are we going to make raising of debt far easier and far more sustainable, just as we have made our equity markets. And there are many areas which we need to work on. For example, the rationalization of taxation. I frankly believe, and we are maybe 45 days away from the next budget, therefore, maybe since the chief economic advisor is there, I will take the opportunity. I frankly feel that the gap between taxation on debt or deposits versus equities is very wide. 40 versus 10 or 39 versus 10. It's just too wide. I'm not saying do one or the other, but we got to find a way of making it more efficient so that a saver who puts money in a fixed deposit at 7.5% makes post-tax 4.5 versus the same saver putting money in an arbitrage fund and gets 7.5%, gets post-tax 6.8. So we really need to think about how do we build a seamless engine between three important pillars of policy and regulation. One is the part of policy and regulation which controls the saver borrower. The part two, which is the capital markets policymaker and the intermediary. And part three is the public policy and the fiscal policy, which the three need to work together to build a wonderful, seamless highway for financing our future. And I do believe if we can make a, a strong ability to build deep markets and a sustainable ability to raise debt for financing India's growth, I think we're in a good position. The banking system is in a good shape. The markets are in a pretty good shape. And with a proper framework on the whole policy side, we have a golden period ahead of us. Having said that, I would also say that there are a few areas we need to keep a close eye on as we think about our future. I respect stability, but at times history colors are thinking about the present and the future. What do I mean by this? India has had a very rough history in the financial sector between 2010 and 2020. And therefore, policymakers live with this burden of history or immediate history over last 10 years. I would encourage again for us to think like the US does. There was a Silicon Valley Bank. It blew up. They found an answer, resolved it, and moved on. We need to find a way of how, if things go wrong, we can fix it quickly and move on. So, proactive ability to create an environment that should problems happen, we resolve them quickly. This will enable us to follow a simple paradigm. We need, yes, we need to avoid accidents, but a zero accident policy is a very risky policy for India's desire and aim for high growth. We must have a minimal accident policy. I agree with that, but not a zero accident policy. And then take our fundamental view to say that we must encourage more cars on the road and not less because there may be accidents. We must encourage more roads. We must have good traffic lights and regulation, but not work towards zero accidents. Instead, have minimal accidents, and should accidents happen, quickly resolve them without affecting the economy. If we can get this as a part of our journey, friends, along with serious focus on debt capital markets and debt in addition to equity, and avoid exuberance building into equity markets, we have a great ability to finance with significantly higher growth in domestic savings moving into capital markets, combined with what I believe will be foreign savings, which will want to come in a stable and sustained financial sector of India. Thank you very much, friends.
Thank you, Uday. Really appreciate. Sanjeev, can I now request you to?
Dinesh, Ananta, Uday, friends, good afternoon. It's a tough act to follow after the CA, the top banker of the country, and after all of you all having just had lunch. But let me try. The topic is financing future growth, and we've already heard some interesting opening comments. So, the first thing that I want to talk about before financing is growth. As an economy, we have done fairly well in the last 5 years since COVID, 4 years since COVID, especially keeping in mind the global uncertainties that started and that stay around us. We know we are the fastest growing large economy in the world. How do we ensure that this growth stays consistent and gets stronger, not for the next 1, 2, 3 years, but for the next decade, if not longer? We know the Dr. Jaishankar earlier today, and Ananda referred to that, spoke about how business needs to take into account national security priorities, national security concerns. But it's equally important for business to know what is the roadmap of the government in the next 10 years, in the next 20 years, with respect to our political alignments. Because eventually, if business is going to raise capital, is going to put that money to work, is going to build economies of scale, this takes time. If there are significant changes in that period of time, it can completely disrupt the entire investment cycle and hence completely disrupt growth. And that's where, to me, when we talk about ease of doing business, we talk about the costs of doing business. Credit is there to our government in the last 10 years that they've done a large amount of work in this area. What we need now is to together help with whatever level of visibility and certainty is possible, because nobody has a crystal ball, we know that, of what are the kinds of business lines we should focus on for the next 10 years, where our policies would remain consistent. What are the type of business lines we must focus on the second decade from now, which means we need to start seeding those in the next 10 years, because there are some segments which take that much longer. So I believe that a collaborative narrative around the greatest possible visibility on what does India want to excel in from a business and an industry point of view will be very useful for so many of you all over here who are here doing businesses of various sizes to know what to do and, more importantly, what not to do. Now let's come to the other side of the challenge and the opportunity, which is how do you finance this? In 22, we were the eighth largest attractor of FDI globally. The entire expat community is now the largest supplier of any country for expat capital. We can see in so many industries foreign money that has come in. And to my earlier point, the greater there is certainty and visibility on on keeping policies consistent, the easier it will be for us to attract foreign capital. Because there are almost no other countries, and as we know, barring one, which can talk about a middle class, which is anything between 300 and 500 million people, depending at what price you want to sell them your products and services. So the world wants to come here. How do we ensure that we create a consistent framework for them to come here? The next source of capital is long-term capital, pension money, insurance money. In the last 20 years, the insurance sector in India, after it opened up to the private sector, has grown 20x. The public sector insurance companies are all multiples of what they were in 2001. And the private sector has grown tremendously as well. Now, in most developing parts of the world, insurance and pension money, which is long-term money, is deployed for long-term uses. In India, this is still in a phase of infancy. For example, being in the insurance business, I know that 50% of the money we collect has to be invested only in government securities, state government, central government. Now, that was okay 20 years ago when we were all newcomers in this business. I believe the time has come now to review that percentage, bring it down. The government can always raise money from other sources. It will force us to start building markets for other long-term asset classes. And in any developed country, it's not banks that go and fund roads, airports. It is this long-term money that does that, which means that if we can adequately channelize it, then banks will get freed up of a lot of their money, which needs to go into encouraging entrepreneurs, startups, small size businesses. They are the ones that need the risk evaluation, which bankers are best equipped to do, and to be able to grow that entire ecosystem. And that's where the bank capital gets better utilized. And as that happens, the next source of capital is with NBFCs. We know today that some of the large NBFCs in the country are larger than most mid-sized banks. They have shown that from being obscure last mile lenders of capital in the past decade and a half, they are now able to compete with many of the top banks in almost every line of business. How do we see that with the right regulatory oversight, and the regulatory oversight understandably and correctly has increased on the large NBFCs in the past 5, 7, 8 years? How do we see that we also facilitate them from a regulatory perspective to see that they go and do more and more, lend more innovatively, maybe take a different level of risk than what banks have the appetite for, and that way reach every corner of the country? And finally, it is the last source of important capital is your money and my money. As India goes from a 27, 2800 dollar per capita economy to $4,000, $5,000, $6,000, as we have seen everywhere around the world, beyond about $3,000 per capita, most people have already saved money for their house, for their children's education, for a few vehicles, something on the health side. And the incremental money they earn should and can go into financial savings. But for that to happen, we have to first start with education and literacy. Right from high school, we have to start introducing courses for youngsters to start understanding what it means to save, what are the different products, what are their risks, what are their returns. Take that through college so that you create that awareness and capability for people to know that once their basic needs are taken care of, then the incremental money can go into financial assets and can thereafter help multiply their savings over a longer period of time. As we do all this, a large part of the regulatory architecture, the policies, the fiscal policies, and Uday talked on taxation, we have to ensure that we align all this for where we want to be in 10 years' time. We have to incentivize the right sources of capital, disincentivize where we don't want it to go, and stay consistent with that. And with that, I'm very confident that we will create the awareness, the availability, and the accessibility for capital to help us finance our future growth. Thank you.
Thank you, Sanjeev. So I think we have, I would call it maybe slightly differing, but very similar thoughts in terms of how we are going to finance our growth from three of you in different areas. So if I can kickstart a couple of questions, and of course I'll be very free to allow the panel themselves to ask the others questions because you're as much, I would call it, better off than me trying to pose. But I think one fundamental issue which I had was I don't think there was a coverage in terms of how much of domestic capital versus how much of foreign capital we are going to be attracting, and what are the challenges and risks we face when we look at getting in foreign capital. For example, are we going to have certain rules and standards being laid which is going to compel businesses to grow in a certain manner, as the case may be? So maybe Anant, I'll start with you on that and then come to Uday.
Thank you, Dinesh. I think you are right in saying that the areas of convergence between the three panelists are more than the areas of divergence. That is good. I think I did try to address this issue of foreign capital. First of all, we need to understand that growth, for its by its very nature, is largely self-financing, because economic growth generates the income, the savings, and therefore uh, it finances itself to a large extent. Therefore, by definition, bulk of the savings needed for growth will come from domestically generated funding. And I think while in the past we used to feel that India can safely run a current account deficit of between 2 and 3% of GDP, I think there are two competing forces on this number. One force tells us to be cautious and not to take this number 2 to 3% for granted. There is another development which, if sustained, can allow India to actually run a slightly larger current account deficit. Let me take the negative one first. If geopolitics remains what it is, we will be subject to frequent bouts of risk aversion in the market and fear. And also, if you look at the data, after the Inflation Reduction Act was passed in the United States, more capital actually has flown into the United States away from emerging markets, from the rest of the world. So the competition is not between emerging economies or developing economies, but between developed economies. And we had Mr. Macron giving some very important speeches in the last 1 month at the Sorbonne University and also to the economist, saying that European Union also has to follow similar policies. If that is the case, the reliance on foreign direct investment, we have to be very careful about how much we can do. So simply because we think the world is very positive about India, money will flow in. That is the short term difficult part. The long term positive aspect for us to attract funding is if we cross a particular inflection point in our GDP size and we become a player to contend with in the global arena as a large economic power, then the ability to withstand short-run market turbulences and run a slightly higher current account deficit also goes up. So I think I would therefore to put a finality to this point, in the next 3 to 5 years, we should still remain cautious about the extent of reliance on global funding. But in the second part of the journey towards 2047, I think there will be opportunities for us to take in larger external capital. This is the way I would frame it for now.
Thank you. That's helpful. But Uday, maybe if I can turn to you, as a financial sector, we heard today morning both the CEO of Niti Aayog mentioned that the scale and size of the banks and the financial sector in India has to be very vastly different from what it is today. So, how do you see that going forward, and what do you think we need to do to make that happen?
So, first of all, I on the banking sector, I think banks really need to scale up more. But what I would tend to believe that is in addition to banking, and which is what the crux of my point was, we need to be dependent on financial markets as a much larger part of our future. And there is a reason. The reason is intermediation through financial markets and the market forces is at a far lower cost of capital or conversion than what it is in the saver borrower model. Therefore, we of course need to make our banks larger, but we have to fundamentally have a mindset shift to say that we have two intermediation models, and the other intermediation model is in fact growing faster. You just have to look at the last 10-year data on growth in bank deposits versus growth in mutual fund industry. And mutual fund industry has grown at twice the speed of the bank deposit market. So something is happening in our marketplace which enables us to be taking an advantage. And there again, Europe versus US. Europe has been much more a bank-led market. US has been much more a markets-led growth. And I think the US model for us is possible much more than just the banking model. That does not mean our banks don't need to get to size. But here again, on banks getting to size, there are two parts to it. One is to say that we need more banks. But you keep in mind that there is a very important systemic issue of how we manage and oversee many banks. Because, for example, we started with the experiment of having a large number of cooperative banks. And we have seen where it has ended. We are actually shrinking them. So the last thing we want is having a situation where we open a floodgate and then have to pull back. We should not, therefore, more banks are welcome, but even more so, larger capital, larger balance sheet, and a clearer road of how banks can go for the future. And that includes some risk taking by policymakers and practitioners, which is to be a measured risk taking to be able to grow. For example, in India, acquisition finance by banks. Unlike for NBFCs, NBFCs are allowed to lend against shares. Banks are allowed to lend against shares only rupees 20 lakhs per bank. Therefore, if there's a large acquisition for a company in India, you cannot finance it in India. So we need also to be able to take some of those calls from a policy point of view to be a little bolder into our future.
Just want to add one follow-up question to that, if you don't mind, to you. So we did speak about the deepening the debt market and working on it to increase it. Now, of course, we have some of the funds, some of the indices being included from JP Morgan and Bloomberg. But how do you see that going forward? What do we need to really create scale?
First, and I think Ananta and his team in the finance ministry are working hard to ensure that the government asks for less money and gets better on fiscal deficit, okay, without taking away too much on taxation. So you need to manage both sides, Anant. Okay, don't tax us more and have a better fiscal deficit through growth in revenues, like you're seeing, for example, in GST. So I think one is to, I think in a more sort of responsible kind of perspective, India needs to continue down the path which it has over the last 3 or 4 years. We shot up our fiscal deficit in the COVID era, not as much as the rest of the world, but we did still go up. We are beginning to come back to more prudent and reasonable levels. We should continue that path of fiscal consolidation. So the absolute amounts, even if they go up on a percentage basis, the size of government debt does not go up to the same extent. Then more supply. We have opened up the window for overseas supply. I think Sanjeev's point is very good. If, say, for example, insurance companies are supposed to put 50% of their money in government securities, can it be gradually reduced to 45, 40, so that it is available for investment and alternative investments? How do we ensure that private sector is not crowded out of the savings of the system? That will enable us to finance the economy much more from domestic resources in addition to foreign capital. And on foreign capital, I think Ananta made a very good point about, finally, the amount of foreign capital you need is first and foremost of all equal or more than financing your current account deficit, because that needs foreign capital. So you've got a historical stock of that gap which is funded by foreign capital, which needs to be renewed. Plus, if you have current account deficits, that needs to be financed. On the point which he made about current account of our ability to take more current account deficits, like he gave the US example, I genuinely believe there's a huge opportunity for India to get towards capital account convertibility, and over a 10, 15, 20-year period, see if we can get to the unique status of a reserve currency. The beauty about our reserve currency is you have to be very disciplined till you get there. Once you get there, you can be indisciplined for the next 100 years, like the US dollar has demonstrated.
Thank you. I think there is an interesting way of answering that question. So now, if I can move to you, Sanjeev, I think I had, let me start with the first question, which is obviously, how do you see the non-banking financial companies really supporting the growth of the MSME sector? And how do you see the reach of that expanding beyond that? Is it regulatory issues, or is it any other issues which is preventing them from supporting the growth, or are we already doing that?
So even today, Dinesh, NBFCs play a significant role in financing MSMEs. And I must say, the way the government is accelerating um, public digital infrastructure is supporting this. So, for example, we know how UPI has completely opened up peer-to-peer payments to businesses at zero cost. Um, Many of you may not know that last year, another big initiative took off called the account aggregator system. What this essentially does is today, if you're a businessman or even an individual, and you have your bank account with a particular bank, that bank sees your money going in and out of that account, and on the basis of that, assesses risk and decides what value loan to give to you. But no other bank can see that. So in a way, you're captive to that particular bank. The account aggregator system now allows an any other bank or NBFC to send you, if you want to take a loan, to send you a text message where you can click on that, and through the account aggregator system set up by the government, it's a separate entity like in NPCI, it allows you to share bank statements of whichever bank you want, which you have money in, with the potential lender. And then through the validity of the loan, monthly statements become available to the lender. So essentially, as a MSME customer, and as I said, even for individual loans, this opens up entire banking to you. So we must recognize some of these huge positives. I don't think this exists anywhere else in the world, like with UPI. The government is democratizing credit for the average Indian, whether business or individual. Using this, for example, today I know my own NBFC, Bajaj Finance, accounts for almost 20% of all account aggregator led loan requests because we have adopted it early. We are very digital, we are very clear that we can't take on the big boys by being cheaper than them. We have to be smarter than them, at least smarter than some of them to give us enough growth opportunity. So, so you have some of these kind of opportunities that are opening up. Secondly, the best credit customer is the one that you have a repeated engagement with. Because like they say in Hindi, wo aag ki sharam aa jati hai. You don't default with the person you know. Today, last year, Bajaj Finance again, and I'm only giving our own examples because I have those numbers on my fingertips. We issued 36 million loans. 65% of that was to existing customers. How do we build a relationship beyond an individual transaction with the same entity again and again? From a regulatory perspective, there are still a number of products, credit cards, for example. You have certain facilities like the way you can use Sarfazi for repossession on home loans that banks have a greater flexibility than NBFCs. For good quality NBFCs with a long track record, if the regulator were to look at opening some of these things up, of course, it will bring in more competition. And vice versa. Uday gave the other example. As an NBFC, I can give a loan for acquisition through shares. A bank can't. Um, yeah, if somebody wants 20, 30, 40 lakh loan against shares to speculate, maybe you put some guidelines around that. But if India is going to grow, acquisition is going to be a very significant part of it. And why are we letting some foreign capital earn on acquisition financing when Indian capital can do the same? So there are a set of regulations which, as we are maturing as a country and we are seeing a significant highway for growth in front of us, the regulators need to fine tune, take some methodical bets. Again, to quote Uday, we are not saying take a completely high risk bets, but do it in step by step. But I believe a combination of this is what will not only open up NBFCs, but the larger sources of domestic capital as well.
Just a follow-up question on that, at least as corporates and as CII in a way, how do you think we can facilitate getting access to these funds in a much better or more organized manner? Because I think the big challenge which we will have, I mean, acquisition finance is one example, but as many promoter-led companies are going to grow and also provide for the working capital funding of the tier 1, tier 2, tier 3, I think it is going to become a challenge as we scale. So is there some other smarter way which you think we can be looking at to get access to even global funds, but so to say, keep it off balance sheet in a way, operating through the NBFCs, etc.?
So, as you know, what we've already been doing as CII, because I was the president before you, and now you're finishing tomorrow, and the next president is going to come in, is our engagement both with regulators and with the government is very intense and very collaborative as we bring in best practices. Um, and also, we help assure them of the stability with which we can grow in the coming years. As Uday said, while we can't ignore our history, but let us not fall prey to succumb to our history either. We can hopefully chart a path which is balanced and with a high level of visibility so that for our members and the larger industry as well, they know how to progress in this area.
Thank you. So now what I'm going to request is maybe a final statement from each of you on genuinely, do you believe we have done enough or we will be doing enough to get to our growth targets as we look at the financing for it? And also, if you can just add a closing comment on how do you see the sustainability transition both from large companies and, so to say, the potential to access the funding for that? So, if the three of you can do so, Anand, you want to start?
No, it's whether we have done enough. I think the answer is straightforward. For a country with a per capita income of around $2,700, we can never say that we have done enough. And as we transition to a middle income status and further beyond that, I think we have a lot of work to do. So it is a work in progress, and it's true for even today's advanced economy. So there is no question that in with respect to financing and financial market development and evolution, we have to do a lot more. And I think in all this discussion, I'm happy that Sanjeev brought up this innovation of account aggregator, because we didn't discuss so much. Financing for growth requires financing for SMEs, because without a Mittelstand, a backbone of small and medium enterprises, there is going to be no growth. And how do we finance SME? This is where account aggregator like innovations come into play. They're relevant, but more importantly, I think and this is a gathering of industry and business leaders. We have to evolve the culture of paying small businesses on time, and greater formalization of the SME sector through GST registrations and through Udyam portal registrations, and also bringing them into the supply chain of large businesses. That will ensure that they are formalized. And then harnessing of digital data, which is what account aggregator is about, so that they can create the digital footfalls leading to greater financing from the banking system and outside. And then, of course, for large businesses to embrace receivables discounting, so that working capital needs of small businesses are addressed. And from the government perspective, above all, allowing SMEs to grow through deregulation, then they can become better financial risk for the financial institution. So my last point, therefore, is financing for growth should have a very big component of making sure that there is financing for SMEs. Thank you. Sorry, in terms of the funding. I thought it was the MSME. Okay. Uday?
I'll try and first answer the second question, which is sustainability. I think it's on everyone's mind. And I do believe that the existential risk for planet Earth is higher than the current business model for solving it. And we are all too very comfortable about us doing little bit here, little bit there. Oh, we will do transition finance at lower returns. I think what we need for sustainability is gap funding. Okay. And gap funding needs to be of a scale which is global. And essentially what it means is all the corporate sector from worldwide, which is making profits from planet Earth, should be ready to give a small percentage of their profits every year towards what India has wonderfully developed CSR. Some say 0.5% of global profits, which go into gap funding for sustainability of planet Earth. And on the back of it, if you have that loss funding, therefore, if a project is say $100 and $20 comes at gap funding, which makes the project viable at $80, that's the way to really go after sustainability, because otherwise we'll not get there. And India can actually give a model to the world with our 2% CSR. If we say that 0.25 or 0.5% of that is for sustainability gap funding, and if this model is made global, where every profitable company, starting from Alphabet to Apple, or everybody contribute 40% of their profits into this gap funding, you will have an answer for sustainability and financing of sustainability, because you can then have it leveraged by international institution like World Bank or somebody to really get it to scale. On the point about financing for India's future, I'm very confident that India will get there. Okay. And we have come a long way, but like driving a car, let's stop looking at the windshield. Let's stop looking at the rear view mirror Let's look at the windshield in the front.
Thank you. Thanks, Uday. Sanjeev?
On sustainability for MSMEs, let me provide a slightly different take. Today, and before getting into the green side of it also, there are a number of very interesting and useful government programs for MSMEs. But most MSMEs don't know about it. They don't know how to access it. Today, if you're talking of green financing, whether it's from overseas, large companies will build the capability of accessing it. How do MSMEs do that? Third, certification. You require certification standards for accessing a lot of this capital. I believe that for us as CII and other similar organizations, there is a very important need and opportunity to work with the government and create the frameworks for this so that it's not just large business that accesses some of these funds, tools, benefits, but it goes to the larger MSME society as well. And to the first question, I do believe very strongly that the next 2 decades are going to be amongst our best where it comes to taking us to a higher level of growth, prosperity, development. Um, and hence, to your question, we are just starting, and this dil mange more.
Thank you. I mean, thanks to all three of you. I think we can walk away with at least a very positive feeling that we are doing all the right things and we will get there. So, thank you for sharing this in great detail and thank you for being here with us today. Thank you once again. Yeah. Big round of
Thank you, speakers. That was indeed wonderful session. Before we come to the close of the session, may I request Mr. Dinesh to hand over a moment of appreciation to our speakers. To Mr. Anant Nageshwaran. To Mr. Uday Kotak. And Mr. Sanjeev Bajaj. With this, ladies and gentlemen, we come to the close of this session. Thank you all for joining the session. The journey of co-creating the future responsibly continues with the next plenary session on future on livelihood creation.